One of the traders that we're working with has come up with a simple swing trading idea and a really interesting way of using options to trade that idea with an excellent cushion built into the structure to improve the win rate on the trade. I'm Seth Freiberg, the head trader of SMB Capital's options trading desk here in Manhattan, and the traders on our options desk are well trained in understanding how to apply option strategies to trading systems to improve win rates and provide the potential for very strong returns. In this video, we're going to be covering this simple to understand swing trading idea. So if you'd like to learn how to add a nice cushion of safety to a sound trading system through an easy to learn option strategy, then you should stick around. I think you're going to find this pretty interesting. Hi, I'm Seth Freiberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so one of the things that I see very frequently when working with options traders from all over the world is that as they get more competent at trading and understanding options strategies, they learn how to combine these strategies with directional trading systems in ways that can make the systems more safe and consistent by adding a margin of safety to the trade through the clever use of option strategies. And one of the systems that some traders like to use to determine short-term direction in stocks or indexes is by looking at certain time frames and seeing where a stock or index ends up towards the end of a particular time frame. So for example, this trader that I'm working with, Bill, scans for stocks where, for example, on a bullish momentum trade, the stock or index closes at the end of any 4-day period at or above 80% of the full range over those 4 days. So for example, if you take the 4-day period November 30th through December 3rd, 2020, you'll see that the SPX index closed at 3666, which is within the 80th percentile of the full range that the index traded in for the previous 4 days. So according to this trader's system and the testing that he did, he found that a very large percentage of the time, if the index closed at or above the 80th percentile of that 4-day period's price range, then there's a very high probability of a bullish move over the next 4-day candles. Now, this is very valuable information, and since he is an options trader, he decided to employ a particular option strategy to play this tendency. Before we move on to explain how this trader is using that simple option strategy to exploit this bullish price pattern, I'd like to let you know that if you want to learn 3 option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause the video, sign up now, and then resume watching. All right, so getting back to our bullish options trade, the trader, when he saw this pattern emerge, decided to put on a particular option strategy involving what are known as put options derived from the SPX index. Now, some of you may not understand how put options work exactly, so we're going to do a really quick review of that right now. And for those of you who do know how they work, just hang in there and we'll get back to the option strategy very quickly. Okay, so the best way to understand put options on indexes is to think of them as a bet that the market will go down. The put buyer pays to the put seller what is known as a premium to make this bet, and the put seller is the one who's taking the bet and receiving the premium for taking that bet. The put option bet pays off if an index closes below what's known as the strike price of the put option on the day that the put option expires. If the index does close below that price on expiration day, then the put buyer receives $100 per point that the market closes below that put strike price. So for example, if an index closes at say 40.32 on the day that a put option expires, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below that 4,000 strike price. Okay, so now armed with that background, let's take a look at how this trader likes to express a pattern like this using options. So remember, the way this pattern works, the bullish pattern indicates a likely bullish move over the next four-day candles, which comes out to basically a prediction of the next 16 days. So now at the end of the 4-day cycle ending on December 3rd, with the bullish candle close having taken place like we just discussed on SPX, let's say the trader decides to enter a trade, but in the process he decides to give the trade a little breathing room. So he moves down 1% from the 36.66 close, which puts him at about 36.30. And he goes ahead and sells 5 of the 36.30 puts expiring in 15 days on December 18th, almost the full 16 days predicted by the bullish candle, which closed on December 3rd. And then he heads down 20 more points and buys 5 of those 36.10 puts expiring on that same day. So now when he trades this combination of selling puts below the market and buying puts farther away from the market than the short puts you sold, that combination is known as a put credit spread to options traders. Okay, so let's first look at the cash flow of what has just taken place so that you can see how a credit spread works. And you can see that by selling those 5 36.30 puts, you brought in $37.95. But remember, those are worth $100 per point if the market closes below 36.30 on expiration day. So you multiply that by 100 and you sold 5 of them. And so the total collected from selling those 36.30 puts is $18,975. And for protection, you buy 5 of those 36.10s, and using that same logic, in this case, you have to pay out $16,250. And so the resulting net cash inflow into your account is $2,725, as you can see from the calculation. Now, your broker, for risk management reasons, is going to require that you have at least $7,275 in your account to make this trade, which is the worst case scenario on the trade. Let's move forward 15 days to the day that these options expired. And as you can see from the price chart, the SPX closed at 37.09 on that day, December 18th, during that fourth and final 4-day candle since we received that bullish signal on December 3rd. Okay, so let's analyze what transpired as to those options expiring that day. And as you can see, it's fairly simple. You see, the SPX closed at 37.09, and therefore any put at a price lower than that 37.09 price expires worthless because, as explained earlier, puts only pay off if the market closes below their strike prices. And so both the 36.30 puts and the 36.10 puts had no settlement value at all. And so what we're left with is the original cash flow we received at the outset of the trade, which becomes our profit, which is a 31% return in a little over 2 weeks. But I want you to focus on one more thing, and that's this. It's not like there's some divine law that requires the market to close higher 16 days later when we receive a bullish signal like this. There are, of course, occasions where this signal doesn't work out and the market doesn't rally after the bullish signal like the one our traders are relying upon. In those cases, you can still make your full cash flow as your profit as long as the market closes above the short puts of your credit spread on expiration day, which in this case are the 36.30 puts. And by the way, that would have been a drop in the SPX price, not a rally at all, which means that if you have a bullish signal, you can win your full credit if the market rallies, as you would have expected, does nothing, or even sells off a little bit, as long as it's mild, and in this case, no more than 1%. In other words, the signal doesn't even have to work at all. As long as it isn't wrong by very much, you're still going to make a fantastic profit. And so what I'd like you to take away from today's video is the fact that there are option strategies that will work very well when the underlying signal you're using is correct, naturally, but the put credit spread also has a forgiveness built into it, such that even if your signal didn't work at all, as it usually does, there are a range of scenarios where you'll win anyway. And that's pretty awesome. As you learn more about option strategies, you're going to see this forgiveness showing up in lots of different ways, which is why the win rates of options income traders are so high and why people enjoy utilizing these kinds of option strategies. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.